U.S. economy sending some serious mixed signals right now. I mean, make up your effing mind, dude. 1 minute, the economy's booming, man. Golden era coming. Next minute, we're seeing President Trump refusing to roll out the possibility of recession. What the F is going on out there? But let's be real. Financial markets do not like uncertainty. And that's exactly what Donald Trump is strategically doing right now, introducing shit tons of uncertainty into the market. Basically alpha mogging the entire U.S. stock market down. Go down! So is that just a growth scare? Or are we on the brink of a recession? Not just the new Great Depression. It's over. In this video, we're going to figure out what's going on. I'll break down why the U.S. economy might be heading towards a slowdown, whether it's temporary or part of a longer-term trend, and what it all means for your investments. Now, let's start with the most obvious indicator of economic health. That's GDP. In Q3 of last year, the U.S. economy was looking pretty damn good, growing at 3.1%. My dog, let's go. Then in Q4, it dropped down to 2.3%. That's still pretty good. Doesn't sound like that much, but trending in the wrong direction. Red flag. Here's where it gets more concerning. The Atlanta Fed's economic growth forecast for Q1 2025 took a serious hit in February. It dropped from a solid 3.9% to 2.1%. And it didn't stop there. Oh no. No, it kept falling. Then by early March, the forecast actually turned negative with a projection of minus 2.4%. That's an insane decline. Minus 5%. What? Now, that was later revised. I said, well, gold imports kind of messes up. It's actually 0.4%, not negative. But this is crazy. It's not what you'd expect to see if the economy was heading in the right direction. In fact, it's what you'd expect to see if the economy is headed for recession. Much of the negative estimate is due to the front running of higher tariffs on imports. So there's that as well. Investors have feared Trump's tariffs so much, they've turned to gold. Gold prices have skyrocketed, but when gold makes up 60% of total imports, it's only made things worse, widening the trade gap and continuing to basically see growth slow down. Things are turning ugly pretty quickly. The fear is high, which makes the next GDP update to the GDP forecast on March 17th, same day as the Fed meeting next week. Shit. A very critical one to watch. Now, before we get into the rest of the story, real quick, guys, if you're trading these cryptocurrency markets, look, I know it's been crazy recently, but guess what? You can make money when markets dump. You can make money when markets pump. I want to take a moment to let you know how you can get $50 for free with Femex, one of the top crypto exchanges. Look, markets go up, markets go down, but you can trade both ways and make money both ways. Even if it feels a bit dirty making money shorting sometimes. And the OG exchange, Femex, is a great place to do it. It's available to everyone, everywhere. It has deep liquidity, all the top trading pairs, and currently they're running a crazy promotion that you may want to take advantage of. So you get $50 for free just for signing up using the link down below. You'll get a 20% deposit bonus. So you deposit $1,000, get $200 back, as well as a $1,000 trading bonus. Pretty damn cool, right? All you have to do, use the link down below to start your account, and you'll be eligible for all of those bonuses. Go check it out if you're a trader and you want to be trading in the markets and taking advantage of that offer, but also of all the trading opportunities available. Okay, so let's continue. Now, look, as the economy cools down, it's no surprise that we're starting to see cracks in the labor market. The latest job report shows a massive spike in layoffs, 172,000 in February alone, which is up a bit from January. Let's just say job layoffs are at their highest levels since July 2020. So that's a big concern. It's up triple digits. Along with that, unemployment rate has ticked up from 4% in January to 4.1% in February, which is not a very big move, but it's the broader U6 employment measure, which is an indicator that includes part-time workers and those who have stopped looking for jobs. That's really catching attention, and it rose from 7.5% in January to 8% in February. And that's a key indicator that things might not be going as well as the headline job numbers might suggest. Under the surface, there's a lot of jagged rocks. On the bright side, job openings did see a rise in February. The economy still added 151,000 non-farm payroll jobs, which is good. Good. Residential construction payrolls were pretty flat, but there was still some growth across various sectors. However, the overall number did fall short of the 170,000 job creation forecast. So less than expected, but still pretty good. So again, signals that the labor market could be cooling a bit. It's not full-blown crisis levels yet, but it's clear the jobs market is shifting. We're seeing some signs of weakness coming in, but the jury's still out on whether this will tip into a full-scale recession or just a short-term growth scare that might even just end up making the Fed act. For now, at least, the labor market is telling us it's just a growth scare. Let's have a bit of a plot twist here. Inflation. Fuck. Now, if you've been watching the official CPI data, you'd think inflation is still a super serious problem. You see, inflation levels have been rising since September 2024, but there's another measure you should be paying attention to, and that's trueflation. You see, the Fed, as always, is basically behind. Trueflation is a real-time inflation tracker, which is showing that U.S. inflation has absolutely collapsed. It's now sitting at 1.39% at the time I'm recording this video, well below the Fed's 2% target, because the Fed's always behind. They're a major lagging indicator. And if trueflation is on point, this could be one of the most important data points of all right now, because it suggests the Fed has already won the inflation battle, and aside from politics, they don't really have a good reason to not cut more rates. But here's the thing, if inflation is crashing and GDP growth is slowing down, you could be heading for deflation territory, which is also not good. And what does the Fed do in a deflationary environment? Cut interest rates. That's what's coming. We are now looking at 3 interest rates this year. Speculation is building. The first rate cut could come as soon as April now. So March, you should not expect a rate cut. It'd be a real surprise if we got one in March. But April, probably going to get a rate cut, or at least a very decent chance of getting one. The most likely scenario, it's almost certain we're going to get one in May, and almost guarantee we're going to get one in June. And that could change everything, especially for asset prices. Assuming, of course, that it's not a reactionary, like, oh my God, we're in a recession, everything's terrible, now we'll cut rates. But if you wonder where the economy's headed, look no further than the bond market. Right now, it's not sending out full-on sort of a recession alarm signals, but it's definitely sending out some red flags. The yield on the 10-year Treasury has fallen from 4.79% in January to 4.3% today. A minimal drop that's nowhere near the fall in yields that Trump needs to make everything better, to restart the housing market, to restart business investing, all that kind of stuff. But on top of that, corporate bond spreads are also now showing signs of stress. This is how much extra yield investors demand over treasuries to compensate for risk. Those have widened slightly, but aren't yet flashing any major red flags yet. This tells us investors are not predicting a major credit crisis, yet. But they're definitely feeling more cautious and more pessimistic. The bottom line here is that the bond market seems to be betting on a slowdown, not an outright recession, not a financial crisis, not yet. The markets are now expecting the Fed to step in with rate cuts to ease the pain, and expectations for those cuts have ramped up. So growth scare, slight slowdown, cuts come, things gear back up. At the beginning of 2025, investors were predicting just 1 rate cut. Now, again, they're anticipating 3. Now, if the Fed moves faster than expected, it could really change the dynamics of the market much sooner than expected. This growth scare is obviously real. There's been huge amounts of panic in the markets recently. But it's also not a foregone conclusion that we are heading for a recession, at least not yet. Remember, 10 out of the last 3 recessions have been predicted at length by economists. Nothing often happens, but at some point there will be a recession. Is it going to be now? That's the question. So far, so good, but things can change quickly and you have to be ready to adapt. The next few months will be absolutely critical, especially with GDP revisions, inflation numbers, job reports. This is all the most important macro signal to watch out for right now. But either way, smart investors don't panic, they just adjust. Move with the flowing tides of the market. The most important thing for investors to remember right now, stay calm, stay focused on your long-term goals. Don't think about what's going to happen over the next week or the few weeks. Where can you be with your portfolio and your wealth in 5 years or 10 years? I know that's boring because you want to get rich right now. I know, we're going to go get a fucking Ferrari, man. And you have to wait a little bit, okay? Look, a growth scare doesn't necessarily spell disaster. It could just be a temporary slowdown. Fear over the tariffs and all that kind of stuff. And as soon as we start seeing some deals get made, then no one's going to be worried that much anymore. And in the world of investing, downturns often present opportunities if you have the right mindset for it. Thanks for watching.